You only have an HSA as an option when you're in a high deductible health plan. The key difference with the FSA is if the employer offers it to you, you can take it no matter what your medical benefit is.
Welcome to Under the Coverage.
During each episode, we interview people, sometimes it's just each other,
Who spend their working days focused on health benefits and healthcare.
As consumers, we want the same thing you do.
We want the entire system to be less complicated.
Our guests share insights about how they navigate healthcare and the health benefits system.
I'm Jolene Myers.
And I'm Sarah Flusky, and we're ready to lament,
Complain,
empathize, and maybe help a few people.
Today, we're going to eat a bowl of alphabet soup. So we're going to talk about HSA and FSA. They're different, they serve different purposes, but cover some of the same things. As you're planning for open enrollment, we want to help everyone understand what makes them different so that we can make informed decisions about the plan that's best. So it's going to involve some math again and thinking ahead, but it's worth it. So first, let's talk about HSAs. So HSAs are only available if you elect to enroll in a high deductible health plan. Both the employer and the employee contribute funds. The money in the account belongs to the employee. And like any bank account, it's yours. So it follows you from job to job. So that's huge. You know, if you leave a job and you want to take it with you, it's yours. So it's an investment. I mean, it's literally called a health savings account.
Literally what it is. But an FSA is a little bit different. So you can't just enroll in an HSA. You only have an HSA as an option when you're in a high deductible health plan. The key difference with the FSA is if the employer offers it to you, you can take it no matter what your medical benefit is. So the FSA is an entirely different vehicle from the get-go. You can have an FSA with any kind of health plan because it's not tied to your medical benefits. It's typically funded entirely by the employee, though an employer could make contributions if that's part of the benefit that they want to offer. But FSAs have unique terms. So carryover, you want to understand if your FSA has a carryover. Unlike the HSA, where that's your money, whether the employer contributes it or the subscriber contributes to the HSA, it's your money, it moves with you, all of that is yours to keep. An FSA has a lot of terms and conditions around it in terms of how that can be used. And one of the things you want to know is carryover. So how much, if any, can you carry over from the end of one plan year into the next? So you get to December, you've got $300 left in your plan. Does that money carry over to the next year or is it gone? So in some instances, you might be able to carry over $100. In other instances, you might be able to carry over nothing. So you could either lose $200 or go out in December and buy $300 worth of FSA eligible items.
Check out that list because there's a lot of things that are covered on that you wouldn't think are covered.
No,
So
FSA Store is an incredible resource, even just to look at what items are FSA eligible. It's just FSAstore.com. There's a link from Nova's website, but you don't have to go through Nova's website to get there. It does a really great job of outlining which items are eligible. I mean, I know people who stock their medical kits for the next year with FSA dollars that they have as they get to the end of the year. So it's not a situation you want to be in, but there's a lot of things you can spend your money on. Run out, something different than carryover. This is a window of time after the plan year ends when you can still submit for reimbursement from the plan year prior based on expenses from the year prior. So your plan ends December 31st. You went to the doctor on December 15th. The bill comes in January. You can use, depending on what your run out looks like, you can pay the January bill with funds from the year prior for services from the year prior. So if I have $100 left in December, I went to the doctor in December, I get the bill in January. If I have run out on my plan, and it's a question you have to ask your employer, I can get reimbursed. I can pay that invoice from the doctor out of the year prior's funds. If I go to the doctor on January 15th, I cannot pay the January 15th bill out of funds from the year prior, even if they've rolled over, if they apply to run out. What applies to run out is the expense has to be in that year.
When you actually went to the provider.
Yep. So the dollars you had available in that year, the expense happened in that year. You just didn't get the bill till January. That's when you can use run out. You can't get a bill in January for a visit in January and pay with funds from the year prior. Does that make sense?
It does.
So you might have 60 to 90 days. That's the period you have to find out. How much time do you have for unreimbursed expenses from the plan year prior to submit them so that you can use those funds? That's the takeaway. Long
Got it.
story long.
Well, long story long, but that's why you can pause and listen to this again or restart. It's fine. Write it down in your notebook.
And then there's grace period. Totally different. This is the window of time after the end of a plan year where you can incur new eligible expenses and use last year's funds to pay for them. Run out, you cannot do that. Grace period, you can.
It
So
makes
this
sense.
is
Think of the words like run out is like
yeah.
no, and then grace period is a little softer. So it just kind of makes better sense.
And it tells you what year you're using funds from. It's just important. These are things like nobody's looking for these terms, but they actually have a meaning and impact how you can use the benefit. So it's like 30 to 60 days, depending on your plan. They can make the decision about what that time period is. So if your plan ends December 31st and you have a grace period, if you needed a wrist brace and it's January 2026, I buy a wrist brace, but I have money left over from my FSA in 2025, I can submit for a reimbursement from the 2025 funds. If I had run out, I would not be able to do that. But because I have grace period and it falls within that grace window, I can. So it's a limited window. The conversation between run out and grace period, that difference is how long you have to use funds in a new plan year to pay for expenses, and then what year those expenses happened in, if that makes sense.
It does. You have to confirm how your plan works.
100%.
So how do you decide?
This is a $1 million question. So if you choose a high deductible plan, take the HSA. The HSA has a higher contribution limit. If you choose a high deductible health plan, you will likely have the option to take an HSA. Take the HSA. Even if you're going to put $10 a month in it, that money is yours. It moves with you. You can spend it on qualified medical expenses. You keep this money for yourself forever and ever and ever. It's a piggy bank. It's exactly what it is. Take the HSA. Now, an FSA isn't tied to the medical plan, but an FSA might make sense for you because you're contributing pre-tax dollars to spend on qualified medical expenses. So it sounds similar to the HSA. It lowers your taxable income, similar to an HSA. But an FSA, you can get reimbursed for everyday items. So ibuprofen, Band-Aids, sunscreen, it's stuff you're buying anyway.
Right.
But if you set aside pre-tax funds to buy those things, you're saving yourself a little bit of money. So you can even just estimate of the things that are FSA eligible, what am I buying anyway? How much do I think that is? And then just use your FSA card throughout the year to make those purchases. So it could be just another way to save money on the stuff you're going to buy anyway.
So you mentioned the FSA.
Mm-hmm.
You mentioned the medical FSA will reduce your taxable income.
Yeah.
Which is savings right out of the gate.
Out of the gate. An FSA store, again, it includes crazy things you wouldn't even think about in terms of what does an FSA cover? Adaptive equipment, allergy medication, mastectomy-related bras, medical, dental, or vision office visits. Those copays can be paid with the FSA. So in 2025, the IRS maximum contribution is $3,300, but you to have tax-free funds to buy on a lot of the things that you're buying anyway. It's going to go up in 2026. It usually goes up just a little bit every year, but you don't have to contribute the maximum. That just is the max.
So basically, if you've been letting your savings account benefits go unused, hopefully this episode gives you a reason to take another look. Next time, we're going to jump in and talk about something that can really cost you, using out-of-network care. Thank you for listening.
Thank you for listening.
This podcast is brought to you by Nova Healthcare Administrators.
Have a question or a situation you'd like advice about?
You can find us on X at UNDR The Coverage.
If you're into email, you can reach us at podcast@novahealthcare.com.
Don't forget to leave a review, give us a like or subscribe, but most importantly, share. We'll find the insiders.
You share it with the outsiders.